From Columbia in the South Carolina Association of Realtors offices, welcome to the South Carolina Realtors webinar series. Past webinars are archived at screaltors.com. Today's webinar again features Professor Joey Von Nessen of the University of South Carolina Moore School of Business speaking on the SC Housing Report. Joey is a research assistant professor of economics at USC, and he is the research economist at Resch Marketing. He's active with the South Carolina Realtors and the Home Builders of Greater Columbia. Professor Joey is a magna cum laude graduate of Furman and a PhD of economics from the University of South Carolina. Welcome, Professor Von Nessen.
Thank you, Byron, and thank you to the South Carolina Realtors for inviting me back for the second edition of the Quarterly Housing Market Report webinar. It's good to be back with you again today. I want to remind you before we get started that after the webinar we'll have a question and answer session, so you'll have the opportunity to submit questions and we'll try and answer those as best we can. And you can also email me after the report if you'd rather ask a question that way, and I can get back to you, and that email address is joey@resch.com, so feel free to email me that way as well. Okay, so let's jump right in. Today's talk is called the South Carolina Housing Market. What's next? What's coming in 2010? What can we say about the status of the economy, the status of our housing market nationally and here in South Carolina? And I want to start off today with a little thought experiment before we go too much further. And it relies on your knowledge of what a truffle is. So I'm going to assume that everybody knows what a chocolate truffle is. It's a chocolate sphere, a little bit larger than a Hershey Kiss. Usually has some type of cream filling or caramel in it, and you get it for about 30 cents at any grocery store. So consider the following scenario. Let's say that you are given the option of either buying a chocolate truffle for 15 cents or you can buy a Hershey Kiss for 1 cent. I want you to think about what you would do in that situation if it's a regular afternoon and you want an afternoon snack. And then think about this alternative scenario. Let's say you had another option. This time you can choose between a chocolate truffle for 14 cents and a Hershey Kiss for free. Now think about what you do in that situation. Well, it turns out that when this experiment is performed, that in the former situation, when you're faced with a truffle for 15 cents versus a kiss for 1 cent, most people choose the chocolate truffle. And why not? It's better than a Hershey Kiss, right? But in situation 2, more people choose the Hershey Kiss than the chocolate truffle. Now, this is an interesting result, and it's actually an irrational result. And the reason is that the price distribution between the chocolate truffle and the Hershey Kiss is exactly the same in both situations. Between 15 cents and 1 cent, there's a 14 cents difference there. And between 14 cents and for free, again, a 14 cents difference there. So why do people prefer the chocolate truffle in one scenario and the Hershey Kiss in the other? And the answer is that people are irrationally biased by free stuff. So in other words, we want free stuff, and that will cause us to change our preferences, and it will override a lot of our other preferences. Now, why do I bring this up? What does this have to do with the housing market? Well, it's interesting because economic models generally rely on the assumption that people are rational. And this example, of course, there's been more research done in this one example. This is part of a broader field of behavioral economics. And it's shown that people are irrational in some cases. And so this creates a problem, and it's part of the problem that we have when we look to forecast and why forecasting, both at a macro and a micro level, can be so difficult. The good news, though, is that people tend to be predictably rational, at least in some cases, and certainly in the case for free stuff. In most examples, people will change their preferences and prefer to have something for free. So this is something that you can keep in mind when you're selling, looking as to which incentives are the most appropriate. Offering something for free isn't a bad idea. Okay, so let's jump in. So starting off today, I want to talk a little bit about where we are. And I bring up this notion of duality because there are signs the economy is recovering, and there are signs that we're still struggling, that we're still a long way away. And you can see this, you can see both pictures when we look at different economic variables. So if we look at GDP, GDP has been growing during the second half of 2009. That provides promise, that says the recession is over, that we're growing again. But we don't actually feel that the recession is over. And although we hear it on the news, when we go to work, when we're shopping, we don't have this sense at work that we're coming out of the recession. We're not seeing a lot of new business. The residential housing market is starting to recover. We're having price and sales stabilization in South Carolina and a little bit nationwide as well that are all pointing signs to a recovery of the economy and the housing market. But on the other hand, we also have investment that is still down. And this is a key, this is something I touched on last time. This is a key variable for looking at long-term sustainable growth. We have to have private investment in order to have long-term growth for the economy and for the housing market, and we're not seeing that trend just yet. Banking problems are creating credit problems, and this of course is important for all small businesses and small builders especially looking to get loans to build, and this is hindering their progress trying to build and trying to recover from the recession. Of course, mounting debt from the federal government doesn't help with that problem either. So we're being pulled in two directions. We've got some variables that tell us, yeah, we're on the right track, we're getting there, and others that say that, no, we're still kind of at the bottom of the barrel and still waiting to crawl out. So let's look at each one of these in more detail and see where we really stand. Starting out, let's take a look at GDP. In the second half of 2009, we had consecutive quarters of growth in the third and the fourth quarter. Fourth quarter actually grew by about 5.7% annualized growth. What that means is that if we were to grow for 4 consecutive quarters at the same rate that we grew in the fourth quarter of 2009, then that growth rate would be 5.7%. So that's what that means. We grew for about 2.1% from July 2009 to the end of the year, and we don't have first quarter 2010 numbers yet, but we can see that we're having GDP growth. This is a good thing, but it's not the whole story. We need to look at GDP and analyze its components. Gross domestic product is a function of consumer spending, which you see C, investment, we have government spending, and we also have exports and imports. NX there represents net exports over imports. C and G there are highlighted in white because that's what I want to focus on for the moment. Consumer spending is up, and it's been up throughout 2009, and this has largely contributed to GDP, to the growth that we've seen in the second half of 2009. However, government spending has been up substantially more than that, and it's actually increased since 2008 to 5.6% of overall GDP. So of course, as government spending increases as a percentage of GDP, what does that mean? It means that everything else is decreasing as a percentage of GDP as well. We can see that in another picture. You can see how government spending as a percentage of GDP has increased really since 2000, and especially since about 2007. And what we're seeing here is another illustration. The percentage is projected to be as high as about 44% in 2010, up from 34% in 2005 and 32% in 2000. So what can we say from this? We can say that we see that GDP is increasing, and it certainly points to an economic recovery, but a large percentage of that GDP is coming from government spending, and that's not a long-term solution. We have to rely on consumer spending and private investment as our primary means to secure long-term economic growth, and that's where we're still struggling a little bit. So let's look at consumer spending and private investment. Here we can see a picture of consumer spending that has increased really since January of 2009, about 2.7% during the entire year. It's projected to be up in 2010, but again, we don't have numbers for that yet, and this will be something that we'll update in the spring housing market report, which will be coming out in mid to late May. If we look at private investment, again, here we can see that huge dip and how we haven't really had much of a trend and much of a reason yet to expect that that private investment has rebounded. We can see that it's bottomed out and it may have turned upward, but again, we need more data to confirm that this is going to be a long-term trend and not a short-term bump in the road. There are good reasons to think that it is, however. One example is the stock market. Dow Jones has been hovering around 11,000, which is a very positive sign for private investment. But this variable is very important and very key to sustain long-term growth. And another way to look at it is to temporarily fix GDP. We can look at government spending kind of as a band-aid. It works for a while, but it's not the key to long-term growth, and private investment is very important for that aspect. Okay, let's look at the housing market. Let's look at South Carolina housing starts and see where we are here. We've recovered a bit from our lowest point, which came in about January of 2009, but about 751 housing starts, which was down from 1,700 starts in January of '08, to put some perspective on that figure. And then in January of 2010, we're back to about 1,025. So we've recovered a little bit and are continuing to do so. You can see in the graph the breakdown of the different markets. Columbia and Charleston doing substantially better than the Greenville, Spartanburg, and Myrtle Beach markets. And there's about a 12% difference. This arrow here marks about a 12% difference there in starts between Greenville, Spartanburg, Myrtle Beach, and Charleston and Columbia. And we want to focus on Greenville, Spartanburg, especially when we begin to look at the different MSAs in South Carolina, because they are really struggling. This is the market in the state that is having the most difficult time recovering. And I want to show you a series of graphs to help illustrate why that's the case. So this first one is a graph of South Carolina housing starts. And notice the trend when you look at this graph. What you'll see is from the early 90s through about 2005, late 2004, you can see a consistent pattern of housing start growth, slow, steady growth. And this is the type of growth that we want to get to in late 2010 and 2011. This is sustainable economic growth in the housing industry that we look to for long-term success. So you can see how that lasted, and then in about 2005, we had our housing bubble, our housing boom, where starts jumped up, and then of course they came down after that. All right, so let's look at a series of graphs of various MSAs, various regions of South Carolina, and look for this similar pattern. All right, so the first one is going to be the Columbia market. And again, you can see how housing starts were slow and steady throughout the 90s into the early 2000s. And it looks here like early 2005 is when the boom really hit Columbia, and then it tapered off after that. If we look at Charleston, very similar picture. Again, not exactly the same, but we're looking at trends here. So we're seeing mild growth throughout the 90s, and again, around late 2004, early 2005, we see that boom, and then it tapers off. Myrtle Beach, same deal. Again, we have a little spike there in the early 90s, but that's more of a just an erroneous data point than part of the trend. But again, we see low amounts of increases, and then again around early 2005 we see that boom. Then one more, this is a little less obvious, but again the trend is there. Sumter didn't have the growth that the other areas of the state did. They were very constant throughout the 90s. But again, you can see a little hump there around the end of 2004, early 2005, again where the housing boom started. Okay, now keeping all that in mind, now let's look at Greenville. So you can see, and we can draw a circle around Greenville here, and you can see the problem. You can see how this is very much different than the rest of the state. What's been going on? Greenville has been building up inventory of new homes far in advance of the housing boom. So as a result, they have a lot more inventory on the ground and are struggling because they have a greater supply on the ground there than in the rest of the state. And when you look at these graphs, hopefully it's fairly obvious how they are different from the rest of the state. Let's take another perspective on that. If we look at a graph that we created, housing starts relative to normal. What this represents is if we take housing starts from the late 90s to the early 2000s, we can get an average of what housing starts in various markets looked like before the housing boom. That is, before we had the collapse in 2008, before we had the boom in 2005, back in the day when things were what we call normal, quote unquote normal. If we take an average of monthly housing starts, then we want to compare where we are today, where we were as to where we were then. And so that's what this graph demonstrates. And so we can see, if you look on the left, for example, the Charleston market, today we are about, or rather at the end of 2009, about 58% of the housing starts. The housing starts are at 58% of where they were during that pre-housing boom average. If we look at Columbia, it's about 52%. 55% of Myrtle Beach, 46% in South Carolina overall, and then we look at Greenville, Spartanburg, and they're at 23%. So another illustration that the Greenville market is really struggling to recover right now. But the good news is if we look at the blue area of the bars, that represents the minimum point back in early 2009. I pointed to the housing starts were in South Carolina around the minimum in January of 2009. And this is where we're looking at for the blue. So in every area, the red bar, the red portion of the bars represent the growth that we've had since that minimum point. So we are recovering. That is the good news, but we still have a long way to go, especially the Greenville market. Okay, let's look at sales. let's look at the decrease in sales. We can see the percent decrease in the different areas. Again, Greenville leading the way here with about 14%. South Carolina just under 10%, in fact about 8.5% statewide. And new home sales are down substantially more than that in some areas, as high as 30%. So what we can say is that the new home market is definitely struggling more than the resale market at this point in time. And this gives you some illustration on the different areas of the state that are struggling more and struggling less. So how's the market adjusting? So what can we see going forward? That's a picture of where we are. What can we say about what's coming for the rest of 2010? Well, first of all, we're having a price shift to less expensive homes, to cheaper homes. And the reason for this is that, of course, unemployment is up and people are afraid. They are worried about losing their jobs. Recent statistic pointed to the fact that 85% of employed persons are not confident about their employment status. So 85% of people that are working today are worried about losing their job. If you're worried about losing your job, you're not likely to go out and spend a whole lot of money. So people are worried about the economy, they're worried about their employment situation. So if they do have to spend money, they're spending as little as possible and they want to be as thrifty as they can be and get the best deal that they can. How does that translate into housing? It means that they're looking for better deals in housing, they're looking for less expensive housing rather than more expensive, and they're looking for ways to save a buck, essentially. And so if we look at an example of this, I want to look at price depreciation versus a price shift and illustrate the difference here, and then move to an example of data here in South Carolina and show you how one is sometimes misconstrued as the other. So in this example one here, let's look at two situations. One, we have sales in 2007. So let's assume that we have the three sales here outlined: House 1, House 2, and House 3. House 1 sells for $185,000. House 2 sells for $190,000. House 3 sells for $195,000. And then obviously, if those are the only three sales in 2007, then we get an average price of about $190,000. Pretty straightforward there. If we look at sales in 2009, let's say these same houses, House 1, House 2, and House 3, sell now for $180,000, $185,000, and $190,000. So now our average price is $185,000. So the question is, we moved from $190,000 average price to $185,000 from 2007 to 2009. Is that price depreciation or is that a price shift? And as you can see, it's actually a price depreciation, as we expect, of about 2.6%. That is, the houses being sold have depreciated in value by about 2.6%. Okay, let's look at example 2 now. So let's say instead that we have the same sales in 2007, again 185, 190, 195, and the average price again is $190,000. And then we have sales in 2009, again at 180, 185, and 190. But this time we're not looking at houses 1, 2, and 3 again. We're looking at houses 4, 5, and 6. So these are different. So now we have an average price of 190 versus an average price of 185. So what are we seeing? Is this a price depreciation or a price shift? And the answer is this is a price shift. This time we're looking at a 2.6% price shift to the left from $190,000 to $185,000. So what does this mean? This means that the reason I put this up is to illustrate that sometimes we confuse part 1 for part 2. Sometimes we confuse a price shift with a price depreciation, and it's important to make that distinction. And we can look at real-world data now. There's a graph here on house price changes 2009 over 2008, and this is comparing the MLS statistics to the Federal Housing Finance Agency. And the FHFA and the MLS point to price appreciation / depreciation to price shifts. So with the MLS, we are looking at house sales year over year, but the houses sold in 2009 are not necessarily the same houses sold in 2008. So MLS data looks to point us more towards a price shift, whereas FHFA specifically looks at the same house being sold over and over and over again in different markets. So that's a much more accurate representation of whether houses are appreciating or depreciating in value. So if we actually look at this graph here, then we can look at different markets in the state, and you can see that overall MLS is showing a bigger price drop than FHFA, yes, and that's correct, and that's what we would expect, because we're seeing a price shift more so than we are a price depreciation. Of course, that changes in market to market, and we can see that the coastal areas have had the largest drop in prices by both measures, Charleston and Myrtle Beach. But if you look at South Carolina as a whole, you can see that the median price of homes sold dropped by about 8.4% in 2009. That's fairly substantial. That's a large market shift to the left. But if we look at the median home appreciation value, that's only declined about 0.2%. So overall, what we're seeing is that home values in South Carolina are fairly constant on average. They're not appreciating, but they haven't lost the value that the price shift makes it look like they have. So that's an important distinction to make. So the coastal areas, they've been hit hardest with the price decline, but they haven't necessarily been hit by the hardest in sales. So what we're seeing here then is evidence that the second home market is really struggling, but the residential market looks not to be struggling too much more than the rest of the state overall there. Okay, second, what's the second way the market is adjusting in 2010? First of all, we have a new national long-term equilibrium price to income ratio that we want to be looking at. So a good rule of thumb nationally is that consumers can typically afford to buy a house that's about 3 times their income level. So if a customer is making $50,000 a year, then they don't need to be spending more than about $150,000 to buy a house. Now, if you look at this price to income trend throughout the 90s and the 2000s, what you notice is that during the time of the housing boom and slightly before, this rose, and I think if we move forward, there we go, we have a picture of a line there so you can see where that 3 value is. Really, right about the time that the housing boom came along, we moved above 3. So that means that people with $50,000 were buying houses that didn't cost $150,000, but were costing $175,000, $200,000, and so on. So they were overbuying what they could generally afford. And this is obviously not sustainable, and it wasn't sustainable. And recently, for the first time, as you can see, we've actually gotten back to the point where the price to income ratio is reached its historical average, again around 3 here in South Carolina. This is a very positive sign that it's coming down. And of course, not in all markets yet, but we're actually moving down back to that level where we need to be. Third, how else are we adjusting? We're adjusting by lowering the levels of inventory in the state. This is a graph here of existing single-family home supply. And again, there's a line there that we can see that you can kind of get a gauge of where we currently are. But we've essentially moved from about an 11-month to a 9-month supply of inventory recently. And this is a very positive sign. There's been a lot of inventory on the ground that we talked about in different markets. And some of this inventory is homes that consumers are not actually interested in buying as much anymore. So why is this the case? Well, with a high price to income ratio, part of what we're seeing is that consumers were trying to buy houses that they could not afford to stay in necessarily long term. So that means that more expensive houses were being bought. Couple that with the fact that now that consumers are very thrifty and they are looking to spend as little as possible, what's left? What are you seeing? What you're seeing is that you have a large supply of housing on the ground that is more expensive than consumers are wanting to buy. So this is making it difficult for some of this inventory to be taken off the ground. Fortunately, though, nationally we're seeing that inventory is coming down, and we can look at new homes as well. That's moved from 12 months to about an 8-month supply. And again, we have a line on there to help you compare there from left to right. So what this means is in states such as South Carolina, where we've had relatively fewer foreclosures compared to the rest of the nation, it's actually up close to about 2% now, which is fairly low. We've had about a 2% increase in foreclosures in 2009 and early 2010 over 2008. And that means that overall we're seeing a net decrease in inventory levels. And this is very important to get back to a state of equilibrium in the housing market. Okay, so what's the bottom line? What are we looking at here in terms of the future? First of all, the South Carolina housing market, it's bounced back from its low point in 2009. So we reached our bottom around January of 2009. We've been climbing since then. We've had positive news with GDP. We've had positive news with price to income ratios, with inventory levels, signs that the economy is turning around. Again, we have that private investment problem that is very important. is very key to a properly functioning economy in 2010. There's a graph here. This is one that I showed you last time. This shows tracks private investment over time, but it also highlights the recessionary periods. And you can see that private investment correlates with the recessions. You can see that private investment jumps after the recessions end. So we have to get to a point where investment is increasing to have long-term sustainable growth, and that's something that we don't have yet, haven't yet observed, although private investment is expected to be up in 2010, so we're hoping for some good numbers here that will come out on the first quarter of 2010 shortly. Third, unemployment remains high, so today's home buyer is very frugal. And this is something that we probably all know going out and interacting with customers, but it's very important to keep this in mind, that we're seeing this price shift to the left, that home buyers are very wary, they're very worried about losing their job, they're looking to get as much of a deal as possible, as much of a bargain, and they're not looking to spend anything more than they have to. So this is important to consider when interacting with customers. And then finally, the housing market, we're seeing lower inventory levels. And this is true nationwide. Of course, it's being offset a little bit by the increase in foreclosures, but in states such as South Carolina, where the foreclosure rate is relatively low anyway, this is generating a net decrease in inventory levels, which is good for the state overall and for the resumption, getting back to an equilibrium point for the housing market. Thank you for allowing me to talk to you today. I think we have time for some questions, and how are we going to do this? Okay. We have some questions on the board, so I'm going to take a second to read it. We have no mention of York County area. Given the proximity to Charlotte, the person asking the question, saying York County is quite different than some of the other areas analyzed. So, okay, they would like some comment on York County. To my knowledge, York County is somewhat similar in terms of these trends, but we can certainly incorporate that into and give you some specific statistics into later reports, absolutely.
It says on months of supply, what data source is used and what is the calculation?
Okay, it's hiding from me, sorry.
Okay.
On months of supply, what data source is used and what is the calculation? That comes from the National Association of Realtors, and that looks at inventory on the ground that is, I believe, past 90 days. Oh, that's a different statistic I'm thinking of. Yeah, that comes from the National Association of Realtors, and they calculate standing inventory on the ground there. Can we provide market trends in each county compared to the state as a whole? We can look into doing that, yes. Looking at a county-to-county basis, this is something that I'm hoping to develop for next year, as looking at it on a more micro level. What I would like to do is get county-level data that we can do that analysis. One of the problems now is getting good data at the county level, and that's part of the reason that in some of the statistics that I show you, you see MSA level rather than county level because the data just aren't there. But one thing we are working on for next year is better data to be able to do that, because I would like to be able to do everything at a county level, if not more specifically if possible.
And what's the
What's
impact?
the impact of the tax credit expiring? That's true. The tax credit's going to expire at the end of this month. I think there will be an impact. Obviously, I don't think it's going to be as large as a lot of folks fear, but it certainly will have somewhat of an adverse impact. But I think that, and I think too, going into the rest of 2010, we need to look at, and I don't know if this is going to happen or not, or maybe extending it again, because as we continue to move through 2010, this is something that is a part of the recovery, and it certainly contributed to the recovery. And it doesn't make sense really to take it away just as it's beginning to have these good effects, because the housing market is certainly not recovered yet, although we're moving in the right direction. But it's going to have an adverse impact, but I would say I don't think it's going to be as large as some people seem to fear it to be. How is the foreclosure affecting inventory? Do we have much negative equity in South Carolina? Well, again, going back to the foreclosures, the way I look at that is mortgage delinquency rates that are beyond 90 days, and that's a good proxy for foreclosures. And what we're seeing there is that we've had a small increase in the past year that's continuing to tick upwards, but not at a substantial rate. So I think that we're going to continue to see the increase in the foreclosures, which will obviously have an adverse effect on the price as that continues to contribute to inventory levels. But I think that overall inventory levels are still dropping despite that. So it shouldn't be as big of a concern in this state as it is in other states. The percentage of foreclosures of the Greenville-Spartanburg area and the state as a whole. I'll have to get back to you on that. I don't know what the percentage, if we're talking about new versus resale, we can break that out. If you can actually send me an email on that. Again, the question was, what is the percentage of foreclosures, or what is the number of foreclosures overall in different areas of the state? I'll have to get back to you. I don't know specific numbers on there. As much as a trend that in South Carolina it's lower than average. Appreciation price shift example. So looking back to examples 1 and 2, is this new homes or is pre-owned or both? This is looking at, in the MLS data, okay, so going back to FHFA and MLS data, the question is, are we looking at new homes versus existing homes or both? MLS data is primarily skewed towards resales. So that's looking more at resales. FHFA looks at all homes. So there is some cross there, but I don't think that distorts the reality of looking at the fact that we're experiencing more of a price shift than price depreciation. But yes, that's true. The MLS looks more at resales, while FHFA looks at both. How will short sales impact the 2010 housing market? I think that, well, it depends on what are we defining here as short sales. Are we looking at sales that turn over multiple times, or what's our definition, I guess, of short sales in this case? I need to be a little more specific to be able to answer that question directly. But again, can we send me an email on that, and we can look at that as well. Information on coastal property versus inland real estate. The coastal areas are interesting. They were hit. The inland areas relative to the coastal areas, I think, were more insulated against some of these, some of the booms and busts. Of course, relatively speaking, and the coastal areas certainly struggled. But what we saw there was a rise in prices that was far in excess of what we saw in other parts of the state, and a corresponding fall in prices relative to the rest of the state as well. And so, but like I said earlier, a lot of that was the second homes market. And so, I've heard really horror stories of people trying to sell these properties in Myrtle Beach and in Charleston, where the prices just dropped off just enormously, more than I would have ever thought possible. And that's the reason is that they are more subject to the booms and the busts there than inland. But if we look at actual sales recovery, it looks like that area is recovering just as well as the rest of the state. Do we feel that realtors are overpricing homes incorrectly? Can that affect the bank pricing and bank foreclosures? So realtors are pricing homes too high. Thinking about that, I'm trying to interpret what you're asking there. So in other words, if we are trying to sell a home, or if a realtor is trying to sell a home too high, is that going to affect whether they can get a loan, and whether or not that's going to translate to a foreclosure? I think that, well, obviously, if they're having more trouble getting a loan due to a higher priced home, that's more due to a customer. But if we're looking at how that's relating to foreclosures, the question's been clear there. But Send me an email on that. I'm not exactly sure what you're asking there. According to the slide, then the Greenville market was the only one in South Carolina that actually appreciated over all new and resale homes. Yes, that's true. That's it looks like overall that's the case, and we've seen in others. And again, we can go back, but in South Carolina as a whole, we saw that we've been about even, and in different areas. Let's see if I can pull that up. I guess we don't necessarily go all the way back. But yes, that is correct. It looks as though, here we go. Now this is looking at 2009 versus 2008. It looks like the graph you're referring to, the house price changes in 2009 over 2008. So that's true. So Greenville is appreciating, other areas have depreciated slightly. But again, the focus there is on the fact that we're looking at a price shift is the predominant impact over a price depreciation. Although there has been some depreciation, there's certainly no doubt about that. Yes, that's true. Okay, any other questions?
Hold on, there's
That's all?
one. Wait, there's one more.
One more. Okay, according to...
No, is there a source of information that compares only?
Okay, is there a source of information that compares only the resales in the same homes to analyze true depreciation of those homes? I believe there is. Let me think about that and get back in touch with you on that. You can send me an email on that question that I can look into that for you. I believe there is, but I don't know off the top of my head. Any other questions? That's the last one.
Do you just want to repeat your email address for everybody?
Oh, yes. My email address is joey@resh.com, joey@resh.com. So any other questions, and send the ones that I wasn't able to answer to me, and we'll get you an answer so we can find out. All right, if there are no other questions, again, thank you for the opportunity to speak with you today, and look forward to doing it again next time, and look out for the spring report, which will try to highlight some of these issues that you're talking about, that you addressed today, and answer some of those questions as well. Now that we're coming out in mid to late May. Thank you very much.